Hello, everybody. This is Brian Eichler. Thank you for joining today's webinar. CapTrust, this is our second one for 2021. We do these each quarter. We've been doing them for years. Thank you for joining today if this is your first one. And the investing mistakes and how to avoid them is pretty relevant anytime, any year. So we always rotate these topics. We want to provide you with different information and educate you on a wide variety of different financial topics, but this is always a great one because it's relevant. It never seems to be a year where we don't have volatility and some challenges in the market. So it's important to understand these. Our website, captrustadvice.com, we post these webinars on the website, and that's a great place for resources. Not only you can use the website to register for future webinars, but the past ones are there as well. So if you've missed some in the past, you can just go on there and literally put webinar in the search box and it'll bring up the future ones that you can register for, as well as the past ones, and get caught up on that material as well. So I also want to mention again, the questions are available. At any time you can put them into that questions box like Alex mentioned, and we'll address some during that we can in the chat, but the majority we'll look at doing at the end in a Q&A session. But understand there's over 1,000 registered, and so as you might imagine, we won't be able to address every question that might pop in. But we are going to do additional questions, an FAQ document. So we'll look at those questions afterwards, and within a couple of days, we'll be sending out an email link to this presentation, this webinar, but also that fact document will go out as well so that you can see additional questions and answers that you may have had. So again, I'd like to thank you for joining today's CapTrust quarterly webinar. And with that, I'd like to introduce Deborah Gates, manager in our Advice and Wellness Group, as well as Paul Bach, a financial advisor with our Advice and Wellness Group. Take it away, Deborah and Paul.
Thank you so much, Brian. I want to start with a disclaimer. Within each retirement plan, there are different investment options with a different degree of risk. And hopefully after today's presentation, you'll have a better understanding of the investments you have available within your plan, how to choose what may be right for your situation. And please keep in mind that CapTrust is available to help with investment decisions, but we don't offer any tax, legal, or accounting advice. Today we're going to identify 7 of the most common investment mistakes that people make. We're going to offer you some remedy. We're going to review some pertinent points, and we're going to tell you about your next steps. So, Paul, I always like to start these discussions with a polling question just to gauge the pulse of our audience. So with that, let's look at the first polling question. So, do you feel that your current investment mix is appropriate for your financial goals? All you need to do is answer yes, no, or not sure, and we'll give you a few seconds to provide your responses.
Interesting question, Deborah, because when I started back in the 80s, it is definitely not where I am today. How about you?
That's my assessment as well. However, the great thing about today is that CapTrust is here as a resource for those who might want a second opinion. Mm-hmm. So let's see what the results are. What are those results that we have, Alex? Can we pull up the results?
Yes, indeed. I'm sharing them now. Looks like we have 45% voting yes, 9% saying no, and 6% saying not sure.
All right. So wherever you are, so for those who said yes, we're here to offer you some guidance. If you just need a second opinion. For those who said no, they're not sure, remember you have CapTrust available. And so I'm really excited about this discussion. So let's look at one of the common mistakes. So, sometimes people think that the stock market is the same as the economy. So, Paul, you want to speak to the two and just tell our audience how they're related.
Sure, Deborah, we get that. That is a common misconception. And it's important understand that the stock market is a discounting mechanism, discounting prices into the future based on trends, patterns, relationships, and certain economic data. The stock market and economy are not generally mutually exclusive, okay? The stock market is not the economy. Rather, it is simply one data point that indicates how the economy is doing and may perform down the road. Over time, however, it has become a pretty accurate indicator and does often foretell what is likely to occur in our economy.
All right. So, moving on to another mistake, trying to time the market or market timing. So just want to give you a little background. There's a psychological phenomenon called hindsight bias. And that occurs when someone believes that after an event has occurred, they could have predicted it. Frankly, it's a common bias that all of us have experienced. At one time of the year that we've said, I knew it, I knew that was going to happen. But it becomes problematic when a person is convinced that they can now predict other future events like the market, for example, or how investments are going to perform. What we need to remember is that there are always technical or market indicators which influence when we should buy as well as when we should sell, which makes future predictions far harder than hindsight bias would lead us to believe.
Absolutely.
And so when we look at the Standard & Poor's 500 index, which is more commonly known as the S&P 500 index, it's really a market capitalization weighted index of the 500 largest publicly traded companies in the US. And so this index is widely regarded as the best gauge of large cap US equities. So when we're looking at this chart, we're looking at the past performance of the S&P 500 index for 95 years. And so here we see the percentage of positive returns the S&P had for different time periods. And the greater the time period, the greater the percentage of positive returns. However, the investment process should always be an active one, but managing your money actively is not the same as market timing. It's essentially to ensure that all times that a portfolio has an appropriate level of risk for your circumstances and your preferences. So Paul, let's talk about some of the major market moving events that have happened in the past few years.
Absolutely, Deborah. This slide that you're looking at now reflects the most recent market moving events and their effects on various portfolios. Now, I particularly like this slide because it provides some context to these events, okay? While these represent significant downsides in the stock market, I want you to note that the bond market is mixed. Also note that the duration of each event. While the tech bubble and global financial crisis were especially long by comparison here, it's minor when compared to the 15 to 20 plus years one can spend in retirement. Now let's take a look at the effect of these events on 5 different investment portfolios within these time frames, ranging from the very conservative portfolios to a very aggressive portfolio. Across all portfolios, conservative investors were less affected by these downturns. Okay, the key takeaway here is that the importance of understanding your allocation and risk tolerance cannot be understated. For younger investors, events like these represent opportunities to buy low. For older investors, simply a properly diversified portfolio can be your best friend by limiting your downside and providing you protection. Now we take a look at this slide, some causes of market volatility. When we look at these different causes, it's important to understand that, we just don't know when these events will occur and what their impact will be on the economy and the markets. And, let's not forget about the natural disasters where we don't have to look any further than the snowstorms that occurred in Texas earlier this year. All of these events can happen at some point or another. Investors, it may generate an emotional response in us. And this is what that response looks like. I think everyone looking at this slide identifies with it and has likely felt a number of these emotions when it comes to investing. Don't let emotions make the decisions. Use your head, not your heart. Your goal here is to have a portfolio with an asset allocation that's going to work for you during the market's highs and the market's lows. And remember, if you need assistance with that, CapTrust is here to help. So Deborah, what do we have as the third most common mistake investors make?
Well, the third most common mistake is not considering inflation and the tax implications of your investments. And that really can be a very costly era. So as we look at the basic definition of inflation, here it's important to understand that supply and demand play an integral role in inflation. So for example, during the pandemic, we were forced to shelter in place, which led to an excess of goods such as cars. And this has now impacted the relative price of cars. One of the primary concerns for retirees is how inflation affects their purchasing power, because seniors are more likely than younger consumers to spend money on things that tend to increase in price, such as healthcare. So this chart that I'm looking at right now that I'm showing you, it shows us the effect that an inflation rate of 4% could have on a $40,000 a year salary. Now this shows us that in 30 years, making $40,000 a year would be equivalent to making roughly $12,000 a year now, if inflation were to hold steady at that 4% during that time. Well, the inherent value of money and what goods and services it can buy us. So as things get more expensive over time, you know, we need to make sure that our investment, the investments that we have chosen, that they outpace this increase. Otherwise, we're losing value on our money, even though the dollar amount may not go down, but we're losing value. All right, so you know what, we've hit on inflation. Let's talk a little bit about the effect of taxes.
Yeah. And taxes have certainly been in there. Taxes, as you know, Deborah, I do feel it's imperative that participants at least have a basic understanding of how taxes play out in retirement, or at least know when they need to start asking questions. If all or most of your money is in retirement plans, it's important to factor in the role of taxes when determining your take-home withdrawals from those accounts. Any income withdraw from these accounts will be taxed at your federal tax rate. Okay, so for example, if you've determined that you need $40,000 of annual income in retirement and you plan to have $1 million in retirement savings, a 4% withdrawal rate will provide you with $40,000. However, that amount doesn't include taxes. If you happen to be in a 25% tax bracket, you will pay $10,000 in taxes, reducing your annual income to $30,000. In order to have $40,000 of after-tax income, means that you would need to withdraw about $54,000 from your savings. This increases your withdrawal rate from 4% to 5.4%, which can significantly increase your chances of prematurely running out of money.
I see.
Yeah. And it's also important to consider, Deborah, that, you know, if by chance, if you've created a variety of accounts specifically for retirement, you know, such as retirement plans, real estate investments, Roth IRAs, or other instruments, you likely want to seek advice about the tax implications from a tax professional, as each one of these may have different tax liabilities. One common misunderstanding is that Social Security benefits are not subject to taxation. You know, we hear that a lot. I hear that a lot. Where in reality, Social Security benefits may be subject to taxation based upon the other provisional income that you may receive. You know, finally at this slide, I really want to point out that I always recommend that prior to retirement, it's important to consult with a tax professional so you can optimize your investments and tax planning for your specific situation. Okay.
So that brings us to our fourth mistake, and that we want to look at is the lack of diversification. So I know we have all heard, do not put all your eggs in one basket. Diversification is the practice of investing across the different asset classes in an effort to reduce risk. So the investment landscape is, it's changed. It can be extremely dynamic and ever evolving. Diversification does not mean that you'll never incur a loss. You just want to make sure that you enhance your potential for long-term gains, decrease your potential for loss by creating an investment strategy that's going to take you through the ups and downs of the market. Now, this is one of my favorite slides, and I know, Paul, it's one of your favorite slides as well. I'm going to let you take it, and rest assured that the next time we're getting together for a group meeting or a team meeting, you're going to owe me a coffee, but I'm going to let you take this one.
Deal. It's a deal, Deborah. Thank you. What I like about this chart is that it clearly and concisely illustrates the importance of diversification. We ranked each sub-asset class for the last 14 years from the top performing asset class for that year to the worst. As you can see, there is no pattern. An investment can be at the top one year and at the next year be at the bottom. A well-diversified portfolio, however, may help to reduce the volatility we may experience, versus just trying to guess what would be the best or worst performing asset class in a given year. So really like to see that slide and really illustrate that for people. So let's move on to the fifth mistake some people might make. And that is simply not planning. Nobody I have ever met with plans to fail, right? You may have failed to plan. According to survey data and industry experts, here are the top 5 contributing factors to Americans' overall lack of planning for retirement. When I'm meeting with participants, a combination of being overwhelmed and having conflicting priorities are a very real challenge for a lot of people. To begin planning is easy. It's simple as making an appointment or a phone call to CapTrust to begin that process. And it's very basic. In planning for retirement, you need to understand 3 things: your goals, your time frame, and your risk tolerance. Knowing how much you need to save to reach your retirement goals will impact your investment decisions. You need to ask yourself, how expensive or inexpensive do I want my retirement to be? You also need to ask yourself, how much time do I have until I need the money? If you have a long time between now and when you expect to retire, your investments will typically be growth oriented, right? However, as you get closer to retirement or the time you'll begin to withdraw money, you may want to become more conservative with your investment mix. The last factor you will want to understand is how much risk are you comfortable with, or what we call risk tolerance. Risk tolerance is simply the understanding of your personal comfort level with the fluctuations of your savings within the time frame you have. Bottom line here is, can I sleep at night? Deborah, the 6th mistake that people make is setting unrealistic expectations.
Yes, because that is the catalyst that leads to other mistakes, for instance. It doesn't matter what investment you choose if you're not saving enough. Therefore, it's important to know how much you have, how much you're going to need to sustain you in your time of retirement. It's always tempting to jump in whatever investments happen to have the best returns during the last year. If you see another investment that is similar to yours with a better return, why not jump into it? Well, first of all, past performance is not indicative for future returns. So generally speaking, the higher the risk, the higher the return. The lower the risk, the lower the return. What you want to do is you want to strike a balance and create an investment strategy, once again, that is suitable for your time horizon and your risk tolerance, which is what Paul just spoke about.
Yeah, absolutely. It does become key.
So now we're at another polling question. So let's pull up this polling question. When was the last time that you revisited your financial plan? And was it this year? Was it 6 months ago? Was it a year ago? Over a year? Or never? So please put your answers in. Irrespective of how long it's been, remember that CapTrust is a viable resource in helping you look at or develop a financial plan. So how are we coming with those results, Alex?
All right, we have just over half the audience voting. Let's go ahead and close this out.
Okay.
Results. Very good. So we have 49% voting this year, 18% voting 6 months, 23% saying over a year, and 10% voted never.
All right. So remember, you have that source.
Good numbers.
I'm sorry, what did you say, Paul?
Those are some good numbers. I like to see that 49% of the participants on our call today have looked at their financial plan.
Yeah, I think that when we look at some of the positives that came out of the pandemic, some of it is that we started looking at things. We became more cognizant of what we had. And so I'm pleased to see that. For those of you who have never looked, please don't hesitate to call CapTrust because we're readily available to help you.
Mm-hmm. Yeah.
All right, let's look at the next mistake, Paul.
The 7th mistake people make in investing and planning for retirement is simply lack of engagement. Everyone has their own relationship with money, which will change based on your life events. You know, recognizing those events, Deborah, and asking yourself, how does this change my retirement picture, will and should occur during our working years. You know, everyone on this call has and will have a different situation, experiences, and expectations that change. And engagement helps you adapt to those changes. So, you know, how do we become engaged? First of all, we want to understand that it's an ongoing and integrative process. Understanding your relationship with money. Understanding gives peace of mind and confidence in our overall planning. It brings greater clarity to your vision of retirement, as I mentioned a few slides back. The fact that people are participating on this call today shows that you're already on your way and taking a positive step towards engagement. And then, you know, as always, you know, seek advice and input, you know, directly from CapTrust.
Now, I do have a bonus tip. You know, just make sure that you keep your beneficiaries updated, especially if you have a life-changing event like marriage or children.
Yeah, I think that's a great tip, Deborah. It's something that a lot of us, we don't always think of that, you know, and it's always good to have that reminder.
Yeah. So we have some key takeaways that we want to look at, that we want to address. And so, you know, I want you to remember that there are varying degree of things that we have control on our retirement planning journey. Some things we have total control over, you know, how much we save, how much we spend, and how we manage our investment strategy. Areas where we exercise some control are employment earnings, duration of our own longevity. Areas outside of our control are important to recognize, such as market returns, the laws and policies regarding taxation, savings and benefits. You know, we just simply want to focus on what is it within our control. Oh, you have any other takeaways that you wanted to mention?
Absolutely, Deborah. I just want to remind everybody that timing the market is a trading strategy. It is not a retirement planning strategy. We want you to think long term. Secondly, have a basic understanding of the how and why you're invested. You know, picking a strategy and staying with it until a life event changes either your goals, time frame, or risk tolerance. And you know, you want to have control over the things that you can. And my biggest takeaway, ask for help. You know, for those of you that are on the call, you're showing engagement plan. You know, be engaged and ask yourself, you know, what do I want my retirement to look like? Deborah, any comments on our next steps?
Absolutely. You know what? We've given so much information today, and we really appreciate everyone being so attentive and engaged. But I would encourage everyone on this call who is either looking for advice or want to know where they are on their retirement journey to visit our website at captrustadvice.com. This website is going to let you schedule an appointment at a time that works for you. It also has some useful articles and tools, including calculators, to help project your retirement savings.
You can also reach our advice desk directly by calling 800-967-9948 during our normal business hours to speak with a retirement counselor. Remember, this is a part of your retirement benefits package. You can think of it as an extension of your overall employee benefits. CapTrust is here to offer you independent investment advice and has nothing to sell you. We want to help you be more confident about your financial future and answer any questions that you might have. Deborah, this has been great presenting with you today. But before we go, Brian, are there any questions that we can answer? We may not be able to get to all of them, but let's try and tackle a few.
Certainly, yeah. The number have been coming in throughout, and I'm sure some more will come in here at the end. So I'm going to take a moment to gather a few. There was one that caught my eye early on, and this is referring to volatility in the market. So earlier on, and then about dollar cost averaging, in the sense that with the volatility we've been through, right, pandemic and the market, what if you had received a large amount of money, you just simply had money that was sitting off to the side that you haven't done something with? What are some things to consider around the person's time frame or maybe dollar cost averaging to get back into the market?
Well, I would think the first thing you want to consider is, what, specifically do you want that money for? What is that earmarked for? If it's earmarked for retirement, say, and your time frame is short, dollar cost averaging through volatile periods is important, and you can take advantage of that. And I would say also too that if depending on your time frame, instead of putting it in all at once, putting it in over a certain period of time does make sense. But here you want to identify what that money is specifically for. Again, for retirement, and your time is short, you may want a dollar cost average, but you want to get that to work sooner for you, sooner than later. If the money is for some other shorter term goal, then you would approach it a different way. Those questions become highly personal, because when I get questions, broad questions like that, Brian, I'm usually kind of digging down a bit further to find a little bit more of what the intent and the goal is specifically for that individual.
And the other thing that you want to think about is that when you have a sum of money that's sitting aside, you're thinking about, I'm putting money into my 401k plan, I'm saving, maybe you're set on your retirement. Maybe you want to look at, do you have an emergency fund? And so when we're looking at an emergency fund, maybe you want to set that aside and put that like in a money market fund, because you want that money to be accessible to you. So when we look at emergency funds, we look at like having like 3 to 6 months of your annual salary, or to cover your expenses, 3 to 6 months to cover your expenses. Because what we found out in this pandemic, what we found is that there were a lot of people that didn't have an emergency fund, and they had to dig into and dip into their retirement savings. So it's always important to make sure that you're looking at starting and setting aside money in an emergency fund as well.
That's great. That was also one of the questions too around emergency funds. Is there anything else you'd want to add to that, Paul, around that? When somebody, whether they haven't started one, going ahead and getting one going, or
yeah, Brian, that's a good point. For people that want to start an emergency fund, the importance is to just start putting some money aside. A nice trick that you can use is setting aside, having your bank take a portion of your money and putting it into another account that you may not necessarily have access to via your ATM. Setting up maybe an automatic transfer of a dollar amount each month from your main checking account to this little savings account that you don't have immediate access to is a great way to start putting that emergency fund together. A lot of times people get overwhelmed with, we'll say maybe three to 6 months of salary, maybe upwards of 9, and they get really intimidated with that, right? So maybe you start off with a percentage or a smaller goal to accomplish, and start that process small. Once you begin something like that, it will soon become a habit, over the course of time. So those are two of the simplest ways to really kind of start that emergency fund off. Think of ways to put the money aside where you can't really get access to it, immediately, and start smaller. Break it down to something that makes sense for your household budget.
Yeah, I really like that idea of starting small, because when you think about it, let's say that you have an emergency that is $500 and you need money for that. And let's say that you've been saving $25 here, $50 here, and let's say maybe you've saved $200. So now at least you have $200 of that emergency that you can take care of. So start in those small amounts, $25, $50. I'm telling you, as Paul said, over time that builds up. And at least you would have something toward an emergency as opposed to not having anything. So don't get overwhelmed and intimidated because you're thinking, wow, 3 to 6 months, that's thousands of dollars that I need to have. So just take it small. And then you look at little ways that you can save money, like going to the recycler, maybe eating at home instead of eating out, which we're just starting to be able to do that again. So look at some of those small ways, things that you don't normally think about.
Mhm.
So we also had a variety of really interesting questions. They're all, as we all know, because we do this every day, everything's practically connected to everything else. So we have some questions around taxation. And so I'm going to read those, but I do want to remind everybody, you know, CapTrust, as part of our disclaimers, we don't provide tax, legal, or accounting advice. You're going to want to turn to those professionals when you have questions in those areas, but some general things. So one of the questions was, to y'all, let you answer me either way, how do you know in retirement, right? Everybody goes to start spending money, and we all know from research, it's one of the hardest things to get people to do is spend the money they've saved. How do you know what kind of tax rate you're going to be facing? What are some basic things they want to look at?
Well, you know, we all wish we had a crystal ball to some degree to be able to determine that. You know, broadly speaking, I would, you know, when I'm meeting with younger participants and they have the ability to save, Roth, for instance, is available in the 401k plan. Roth is the after-tax contribution where you pay taxes up front. Younger people will likely be better starting off in Roth, because when you're starting your career in your 20s or maybe early 30s, you're likely in the lowest tax bracket you're ever going to be in your life, right? So pay the taxes now. You know, it would really be hard. It's really hard to argue with 30, 40 plus years of tax-free growth. So younger participants generally may be better off in, starting with Roth. Older participants, when you're in your career, generally they tend to be are probably going to tend to be in a lower tax bracket in retirement. So the traditional pre-tax works well there. As I mentioned, Brian, we don't have, a crystal ball. Some people may just want to have a bucket of money that is they don't pay any taxes on in retirement, along with their taxable income. Deborah, do you have any thoughts on approaching that?
Yeah, because then you can look at the Roth IRA, and so you're just trying to mitigate as best you can. And so even if you just kind of make the assumption of your current tax bracket of what that would look like, but like we've noted, we don't know what the tax laws are going to be at that time. So what you're trying to do, you just try to balance it out. You try to put a little bit in pre-tax, you try to put a little bit in after-tax, and pay some of the taxes right now.
Mm-hmm. And I will say that we do
have some of those investment
on our site.
Yeah, and I'm sorry, go ahead, Paul.
We do have some calculators too that they can use on the CapTrust Advice website.
Mm-hmm. And I would just say for those that only have pre-tax, right? So whether it's at a traditional IRA or whether it's in your 401k or 403b. So as you spend money and you pull it out of those investments and out of the account, that's when it's taxed and it's treated as income, right? So if you think about if you pull out $50,000 and you don't have any other source of income, let's say, then you're in the bracket of whatever 50,000 is, right? Whether it's high or low, that's what Paul was referring to. We don't really know what they will be in the future. But just think of any pre-tax money that's going to be treated as earned income in the future. Whereas the Roth, right? That was the benefit of Roth. You've already paid those taxes early on. So, all right. So another question around this was, is there, from the diversification point of view that you guys were talking about earlier, right? You had the key factors of goals, time, and risk to figure out how we're going to build a portfolio and how we're going to manage it. But what about target date funds? Are they a good choice for somebody to diversify?
Target date funds are diversified within themselves. So when you're looking at, and I'm speaking generally, so what you want to do is you want to look at what your risk tolerance is, your time horizon. But when you're looking at a target date fund, it is an asset allocation within itself. So even though you may have that one fund name, there are underlying funds that make up that fund. So there's a portion going into stocks, a portion going into bonds, a portion going into cash. And it depends on what your time horizon is. So you'll see the name of the fund. It may be the ABC fund, and it's associated with the year. So it may be 2030, 2040, 2055. So what that fund manager is doing, they're looking at that target date, they're looking at that year, and they're setting the goal as that year is when they would start withdrawing money out. So the strategy is based on someone who would have that amount of time. So you want to make sure that you're going into the one that's appropriate for you. So it's based on your age and when you're saying that you would access the money. That's what the strategy is built upon. So you have the underlying fund, so you have the diversification that would be appropriate for you. So what happens, you're placed into an investment mix that's suitable for you today. As it gets closer to that target date, it's going to automatically shift and become more and more conservative as it gets closer to that target date. So when you're choosing a target date fund, you only want to choose one, because you're going to get the diversification that's suitable for you, and especially if you're going into the one that is appropriate for you. Because sometimes I'll see people saying, I really want to diversify, so they may have like 4 or 5 different target date funds. And then I'll say, no, you kind of, let's talk about this and let's look at when you plan to retire. It doesn't mean you have to retire at that particular time, but the strategy is built upon that concept.
Mm-hmm.
Well, that ties in with another question, of course. When is it, as you start approaching retirement, right? When should you start to change your investments into something more conservative? And I know it's a simple question that a lot of people have, but I also know from my experience, it's not a simple answer. So how do you address, from each of you, how do you address that when you're talking to people about when's the right time to start getting more conservative?
Well, that is a good question, Brian. And, I try to tie that, into the life events, because what is happening here? You're approaching retirement. You're getting closer to the time where you're going to start using your money. And that's a time to maybe take a look at your risk tolerance. We don't want people to make changes because of the market is making changes for that, because you can't react to that. But as you get closer to retirement, it really becomes a question of how do you feel about money? And that's why we sit down and we'll have conversations about your risk tolerance. As they get closer, there's no magical age, for this. When somebody goes from growth to moderate, it's not based on really an age. It's about how you feel about money. It's about what do you have going on in your life? What are your expectations, when retirement comes, or your expectations of when you take the money out? So it's really, it's more of having a connection with really what's going on in your life at that time and really how you feel about money. It's really not a hard set age. Everybody as a part of this call is going to feel different about that. And I like to get, and I like to dive down to, what are you concerned, what are your concerns about, making the change, getting more conservative. So it's really just having a discussion. I don't think that there's any magical age to do it, but it's important to understand the risk return, a balance of stocks and bonds, and how a move to more bonds and cash type instruments, provide that level of stability, and how that can affect returns. Kind of ties back into what Deborah was talking about, higher risk, higher return, lower risk, lower return. And it's simply finding a balance of that based upon that individual situation.
So I'd like to add to that, when we say becoming more conservative, sometimes becoming more conservative may be going from 70% in stocks to 60% in stocks. So we would want to look at that, engage that as to what do you actually mean? What are you thinking about when you're saying going a little bit more conservative? Because what we really want you to look at, we want you to look at your time horizon. So not only thinking about when you're going to retire, your time horizon extends a little past that. How long will you be in retirement? Because even in your time of retirement, you still want to stimulate some growth because you want your money to outlive you. So we really need to look at that. What does that really mean? What are you looking at becoming more conservative? Yeah. And then also extending that time horizon to making sure that you have enough money to take you through retirement and sustain you during that particular time. So here again, that's a call to capture so that we could really look at your personal situation. All of this is just general answers that we're giving you, but At CapTrust, we look at you whether you're, we have conversations if you're early career, mid-career, if you're late career. And when you're having a conversation with us at CapTrust, it is a customized, personalized conversation. And you can call us as often as you want to. You call us one time, it may morph into a second phone call or a third phone call. So you're not limited to the amounts of times that you can call us and get information. And so we would want to look at your personal situation and really see what that means to you as becoming a little more conservative, and if this would be the time. And taking in, like Paul said, all of the other factors that are involved with your personal situation.
Okay. That's a great point, Deborah. What is the definition of conservative?
Yeah.
Yeah, well, those are all, like I said, it was a really great question, and it comes up so often when we're talking to people on the phones. And that then ties right back to your target date fund discussion, because it's controlling that, right? If you're in that target date fund,
Absolutely.
You're not deciding when it's going to get more conservative. It's doing it on a glide path. It's doing it from the experience of that fund manager, and that investment committee is making that decision for you, because you don't have to do it, right? You can still make your own investment choices. You can make new decisions, whether you're managing your own portfolio of 8 or 9 funds. Yeah, that's something you may want to consider. But we all have had different people. We've had people that were in their 70s that are still growth or even aggressive, right? That's not typical, but that's what they were comfortable with. That's what they were doing. So it's monitoring and engaging, as opposed to somebody who's, I don't know what I'm invested in. I'm 100% stock, and I don't even know what I'm in, and I'm 85 years old, right? That's a totally different risk factor.
That's a different conversation.
Right, and managing their and paying attention to it. All right, so we got a little bit of time, so I'm gonna go through a couple more questions here. Bear with me a second. Someone also just, if you can ask just briefly about the when somebody has those different sources of retirement savings, as you both were mentioning, between some pre-tax money and some Roth money, and this obviously may come down to would be better suited for a deeper conversation with a tax advisor, but you're given a choice, right? You will determine how to take that money out of the account. So how do you kind of address that when somebody says, well, should I pull some of the Roth money? Should I pull some of the pre-tax money? How does that kind of work when you're talking to folks?
Yeah, I have that conversation. And I think even when we're in our meetings, our general meetings, I'll usually say, when you're looking at, you're taking money out. And here again, you definitely want to speak with your tax person. These answers that I'm giving you is really general concepts. So what you might want to consider, let's say you need, let's keep it just really simple, that you need $50,000 for the year. And you have money in your Roth, you have money in your in pre-tax. And so let's say you take $25,000 from pre-tax, you take $25,000 from Roth, you have $50,000 for the year, but your tax liability for that year would be $25,000. So you could use the money in your after tax to offset your future tax liability when you're taking money out of your pre-tax savings. And that's usually how one of the simplest ways to explain it, but I would strongly encourage you to speak to your tax person, because there are other factors involved that you would need to look at.
Yeah, agreed.
Okay, all right. So somebody asks, well, if I have left my employer, right? Because we, of course, are the advisors on employer plans. And so if I've left my employer, can I still talk to CapTrust? And then in a tie-in to that, if somebody else asks, well, if I talk to you, what kind of information should they have available for an appointment? What's beneficial to y'all when you're getting ready to speak to somebody?
Well, we always, when I speak with somebody, I'd like to, I encourage them to have access to their account information, first of all, so we can go in and take a look at your asset allocation. And it just, enables us to really get a better understanding of where they're coming from, and helps better position us to help answer their questions, not only for their current account, Brian, but for any other accounts that they may have. Having known what's in there, how much they have, allows us to work with them to kind of get a feel for their whole overall picture for retirement. So, as much information as you can provide in that regard, we find that very helpful. Again, when it comes to taxes and all that, we really can't assist with that.
Yeah, you definitely want to bring all of your statements, any statements that you have from any prior plans or any prior accounts. If you married your partner, your spouse, your significant other, if you're, you want to look at a holistic approach, maybe for your household, then you want to make sure that you have that information about their plan or any savings they may have, any accounts that they may have. As much information as you can provide, so it'll be really more comprehensive, so that we can do more of a holistic approach and taking into consideration everything that you've set aside. So as much information as you can provide during that session, yeah, we would be, able to speak with you and do an analysis for you. So that'll be a little bit more comprehensive.
And as you mentioned, you can do follow-ups, right? You don't have to have every answer on a single meeting with us. So
Correct.
no, we're part of your resources with your employers, your employer plans. This came up later on in the questions, but can either of you just give a little synopsis of what is dollar cost averaging? And then somebody else asked about rebalancing. What does that when she was told to rebalance her account? Can you give a little bit of the terminology there?
I'll
Sure.
take rebalancing.
Go ahead, Deborah. I'll let you go first.
So rebalancing is looking at your allocation, what you have, however your money is set aside in the various funds. And let's say that one fund outperforms the other. And now you have a larger presence in that particular fund. And you may be uncomfortable with that. You may not want to have that much in that particular stock fund, but let's say that it's really grown exponentially and you have a larger balance there. You can say, okay, I want to come back to my original allocation. And so you can set up the rebalancing. You can either do it, we recommend you do rebalancing annually because we don't know how the funds are going to perform. And so when one fund outperforms the other, it'll bring you back into your original allocation so that you're more, it really kind of helps with risk when you're looking at rebalancing. Now, when you're looking at the target date funds, it automatically rebalances. So it's going to keep you at a mix that's suitable for you at that particular time. If you're creating your own strategy, you can either rebalance manually on an annual basis, and most record keepers have the tool where you can set it up to automatically rebalance like on a quarterly basis or a semi-annual basis. And so they have that automatic feature. But if your record keeper does not have that automatic feature, you can go in and set up the rebalancing to bring you back to your allocation. And the only thing that's happening that causes you to go out of balance is the way that your funds perform, whether positively or negatively.
Yeah. And dollar cost averaging is the concept of investing a set dollar amount on a regular basis over a long period of time in order to purchase the lowest amount or the most amount of shares at the lowest possible cost. So let me give you an example of that. In the 401k plan, you contribute X amount of dollars, same dollar amount comes out of your paycheck. It gets invested in your investment options and it purchases units or shares of that particular investment. The share value, unit value goes up and down every day. So your set dollar amount that you're contributing on either day can buy more shares or less shares than the previous day. The concept of dollar cost averaging is that over time, your contributions will, as you average all that share prices out, the idea is that your contributions will buy the most number of shares or units at the lowest possible cost over time. So it's a very very set way and a really fantastic way to invest for the long term.
Thanks for those. Now, I have got a question here, and it's a little personal, so I'm not going to go into the quite details on that. But in essence, this is somebody who was asking about they had moved to safe investments, right? So we all presume a money market or stable value fund in their employer plan, let's say. And they did this back during the 2008-2009 time period, and they're still there. And we've all run into folks who are nervous about getting back in the market, especially now that it has recovered and exceeded where it was in the past. So is that an example then where you could use dollar cost averaging? How would you have that conversation? Because we of course would encourage them to call in or make an appointment so we can talk with them about this on their personal level. But it's a good example of somebody shifting their strategy.
Mm-hmm. You know, one of the most difficult things about reacting to the market is moving out of the market and kind of having cold feet on getting back in. So for questions like that, Brian, there's a lot of things I think that need to be considered, you know, in regards to how much time does this person have before they're, you know, before they're going to start taking this money. Can they afford dollar cost averaging, putting it back at one point? Should they put it into a target date fund, or a managed account, or a model portfolio? I think there's a lot of ways to look at that that are kind of unique to the individual. I would encourage that individual certainly to call the advice desk and have a conversation about your particular situation, because when I'm asked those questions, and that does happen, unfortunately, the more than I like, each response is going to be a little different. We've got to tailor it to your situation.
You know, I'd like to add to that. You know what we do know? We know hindsight is 20/20. So before you make a decision, you want to make the phone call before. Call us before you decide to come out of the market. Have that conversation with us, and maybe we can give you some advice. We can advise you and kind of talk you off the ledge before you move everything over into something that's really super conservative. Because some of the options could possibly have been, you know what, why don't we change your future contributions? Or maybe we change your existing balances and leave your future contributions the same. So we can give you some different alternatives. So if you're thinking about doing that in the future, give us a call. I mean, CapTrust is here. You know, the conversation is so easy with one of our CapTrust representatives. They're going to tailor the conversation to you. You're not going to have to know a bunch of financial jargon. We're going to speak to you in layman's terms. It's a very easy and relaxed conversation. And keep in mind that you can call us several times. So I would strongly encourage you, if you ever run into those kinds of situations again, where you're considering moving or you're nervous and you're just scared about what's going on in the market, just give us a call. Just call us. Set an appointment with us so that we can help.
Absolutely.
Great. Well, we're coming up on the end, but I'm going to give one last question to either one of you. And this is back to, of course, contributing to an employer plan between Roth and pre-tax. Is there, if somebody has been contributing to pre-tax most of their life, right, like many of us have who are older, and Roth's available, what are some things you would want them to think about if they would want to start shifting some of that percentage or savings over to the Roth portion in their plan?
One thing I would have them consider, we have some calculators on our website, captrustadvice.com, because although we are saving for our retirement and we want to live in our retirement successfully, we also have to live for today. And so you want to look at that calculator, and because the bottom line is, all right, so if I start doing a portion into Roth, how is that going to affect my take-home pay? So you still want to be able to meet whatever your obligations are. So you might decide to do a portion in pre-tax, a portion in Roth, but utilize that calculators that we have, the payroll calculator, to determine how that would affect your take-home pay. That's one thing that I would consider. The other thing I would consider is, where are you in your time of retirement? Because remember, for the Roth, so that the distributions are tax-free, it has to be in there 5 years from the initial deposit and taking it out after age 59 and a half. So you want to make sure that you're going to meet both of those criteria when you want to pull the money out at your time of retirement. That's normally the first things that I kind of look at when I'm speaking to somebody. What about you, Paul?
Yeah, absolutely, Deborah. I look at that as well, and that's the questions. You know, what is, if you want to diversify in that, from a tax standpoint, what's the time frame that you have for that? What's your expectation that you want to have you know, with that tax-free bucket of money and that pre-tax money, what kind of strategies do you have? Or maybe they just want to talk about it. So I would agree with you that that's the, you know, really where they are and in their age and where they are in planning for retirement to see if it even makes sense.
Well, thank you so much, both of you, Deborah and Paul. Really appreciate all your insight and this great topic that we were covering today that's so important for people. I want to thank everybody for joining this quarter's webinar. Remember, the new one you can register for on our website at www.captrustadvice.com as well. And you can see our past webinars. And we look forward to talking to you in the future. Thank you.
All right, thank you, everybody. Bye-bye.
Thank you.